On June 13th, we saw the latest read of U.S. CPI. Now, the number came out at a lower than expected 4.0% year over year versus expectations of 4.1%, and there was a decline in real weekly earnings. Now, the number confirmed a year-long decline in inflation from the highs of over 9% back in June of 2022. This represented the final major economic data point before the June 14th FOMC decision. Now, going into the number, the Fed funds futures market had a 20% probability that the Fed would hike at that meeting. That probability quickly collapsed to less than 4%. Now, the futures market still favors a hike at the July 26th meeting, although the odds of no hike at that meeting moved from 26% before the data to 35% directly after. This according to the CME FedWatch tool. Surprisingly, the number put upward pressure on two-year yields, pushing them to a 3-month high of just over 4.6%. This is a continuation of a 5-week rally that began with the two-year yield at 3.8% back on May 4th. The market now will look at the PPI number on the 14th and, more importantly, for any changes in the Fed rhetoric in the coming days that could shed light on the Fed's future path. Now, if a trader believes that two-year yields will continue higher from here, they could express that by buying the June micro two-year contract at 4.55 and targeting a move to the psychological level of 5.00. A stop for this trade could be placed below at 4.18. Now, this trade could make $450 if the target is reached and risks $370 if you're stopped out of your level. Now, if a trader believes the two-year yields will fall from here, they could sell the June micro two-year contract at 4.55 and target a move back to the mid-April highs of 4.25. A stop for this trade could be placed above at 4.80. Now, this trade could make $300 if the target is reached and risks $250 if you're stopped out of your level.